Good afternoon and welcome to today's Premium Account ASX Top 50 Short Form Market Update for the 7th of May. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hein, current Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. It is a short form update today, so it's a quick look at the macro update, a roll through the ASX Top 50 stocks with a particular focus around those companies that have provided earnings, updates and the recent transactions on both our internal account and client accounts, and we conclude with a short-term market outlook. The Investor Signals Premium Account service is centred around a model portfolio of ASX Top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, trying to generate above average cash flow from dividends and call premium, while still providing the opportunity for capital growth. The portfolio is managed under strict investment mandate, therefore suitable for self-managed super funds. If you'd like to know more, please contact myself, Leon at investorsignals.com. Moving straight into a graph of the Dow Jones. Now, as we move through the March quarter earnings in the US, the results are mixed. The market's largely been looking past that and still forecasting earnings over the next 9 months to result in the full year earnings in the US growing somewhere around 8%. As I'd alluded to in prior recordings, if the market was to rebase itself on no earnings growth going forward, the Dow should be worth about 14,500 points. Factoring in that 8% forward earnings growth and applying around 16 times forward earnings, the Dow's at about fair value at 16,500. I think between here and the end of August, we're probably unlikely to see the markets do too much at all, and our base case remains that markets consolidate, and it's only in the back half of this year, once we get past some of the headline issues that are occurring predominantly between Russia, the Ukraine, slightly concerns over China, in particular the housing market. I think those type of issues are going to occupy market attention over the next 3 to 4 months, and it's only when we get into the back half of the year that we may start to see more synchronized global GDP growth as a result of Europe improving and the summer data that comes through in predominantly sort of after the June quarter in the US should start to add to the picture that global GDP growth is going to re-accelerate. And in that environment, equities can move higher. Just to have a quick look at a couple of key indicators at the moment. This is a graph of the 10-year treasuries. We can see here that the treasuries in the US have been a little bit negative. Where the equity market's been moving higher, we've seen the yield on the treasuries move lower. Normally what you'd expect to see is if the outlook for robust economic growth was optimistic or positive, you'd expect to see these yields start to move a little bit higher. So we'll keep an eye on this over the coming weeks just to see whether the yield finds support at around 2.5% and gradually starts to move higher. That's one of the indicators that will sort of start to form a base for equity valuations and feed into this view that later in the year we'll see equity values move higher. With some of the conflict that's potentially building there between Russia and the Ukraine and the impact that it's having on policy decisions from the US and Europe, we're starting to see gold find a little more support here. So at 1,300 an ounce, it's interesting to consider if Newcrest continues with its above average production levels and we start to see an improvement in gold price, we may start to finally see that recovery in Newcrest that we've been waiting for. Also just moving on to the Aussie dollar, just to have a quick look at what we're seeing here. So the Aussie being elevated, stocks like Amcor, Computershare, WDC, Brambles are all interesting opportunities at the moment and provide a little bit of a defensive mix if we were to see the yields in the US start to bottom out at 2.5% and we start to see better economic data in the months ahead in the US, then ultimately we may see the Aussie dollar run into some resistance at or near the current levels. Any pullback in the Aussie dollar will help to add to earnings upgrades for some of those names as companies that are earning US dollars and converting back into a lower Aussie dollar will add to the bottom line. So we'll keep an eye out for the trends within the Aussie dollar and the impact that has on some of the stocks within the top 50. From an index standpoint, our view really has been that the market is reasonably full value at around 5,600. We thought that that puts it on about 16 times forward earnings, a compressed 4% dividend yield, underlying earnings growth for our market probably somewhere in the order of 7%. The resources where analysts had been allowing for further earnings upgrades look like probably that won't come through, especially in the context where we see iron ore prices at the moment and arguably probably even oil prices are probably at the top end of their range as well. So that whole commodity spectrum is probably going to find it tough going over the next 3 to 6 months. Our preference still remains BHP over any of the other plays, and we've just recently taken profit on Woodside Petroleum. So from an index standpoint, we're allowing for the market to maybe pull back as low as 5,100. I wouldn't expect it to go any lower than that, and it would find support. But broadly over between now and through to August, September, I think we're largely going to see the index move sideways. Moving straight into a graph of the first stock in the top 50, and I'll move through these quite quickly as we've covered them in some detail. AGK we continue to like, but selling covered calls, not looking for too much in the way of earnings growth there. The stock's trading, as I've mentioned, around about a 4.5% dividend yield. Asiano, improving dividend payout ratio, not looking for too much in the way of earnings growth. I think it sort of starts to move sideways at or near this level, but interesting that it's performing well against a backdrop where we're starting to see some profit taking in some of the other names. So it continues to be a stock that sits on the radar and very well may be deserving of portfolio allocations going forward. Amcor, we've been recent buyers of this. We've been pretty aggressive with the covered calls. We've gone out into the early part of next year to collect reasonable premium on Amcor, and it's delivering about 12% cash flow from that dividend and call premium and providing for about 10% capital growth. AMP, not looking for much in the way of earnings growth here. The stock's trading about 17 times earnings, not one of our preferred allocations at the moment. ANZ, we continue to like this. The earnings result wasn't too bad. To dig a little bit deeper and sort of remove some of the added earnings from the lower provision for bad debts, the underlying banking businesses really seem to be growing revenue at around 4%, costs at about 2%. So the underlying businesses, if we go out across the next 2 or 3 years, probably are not likely to grow much more than 2 or 3%, I wouldn't think. Well, they are sitting at a reasonably high end of their payout ratio for dividends, up around 65-70% payout ratio, and there really is a focus on their Tier 1 capital, ensuring that it stays at reasonably elevated levels. So I think what we're seeing at the moment is, although the headline numbers in these banking results look good, and extensively they are, however, we're probably seeing the best that we're going to see for a little while, and I think the market probably is more of the view that the banking stocks move sideways over the next 6 months. So owning the banks, collecting the dividends and capping them out through the covered call, I think continues to make sense, and we run that as a strategy across portfolios. ASX defensive yield, here we like it, about 18 times earnings and roughly a 5% dividend yield, looking for something in the order of 5% earnings growth in the year ahead. AZJ, interesting the announcement that came out. I've been chatting about AZJ diversifying out of sort of coal haulage and trying to get a foothold in iron ore haulage throughout the Pilbara, and we've seen the beginning of a fairly substantial transaction that's just been announced. Now the market is concerned that that may lead to AZJ having to raise capital. I'm not sure that that's something that it will be an immediate requirement, but down here, the stock's pushing back up to around a 4% dividend yield. The company's going to grow earnings roughly 20%. I think it's a buying opportunity on the dip here at around this 475, 480 level. BHP, we continue to like this within the resource space. The company's likely to announce a share buyback in the next 3 or 4 months. Right at the moment, though, with iron ore down at sort of $110 an ounce, at 110 a tonne, I should say. The prospect of BHP delivering substantial earnings growth is fairly diminished, and I think that puts the stock at about 13 times earnings on a 3.5% dividend yield, which is about fair value, so we look to sell the $39 calls over BHP. Brambles, 7% to 8% earnings growth going forward. This could be a beneficiary of a lower Aussie dollar, but really here at $9.50, the stock's full value, 19 times earnings on a 3% dividend yield. So we want to own this name, but we need to sell the covered calls to drive that 12% cash flow. Coca-Cola have a shareholder meeting in Sydney next week, so I think we're probably likely to see more optimism around the strategy that the new CEO is going to deploy there in Coca-Cola, and part of that will be centred around cost control initiatives, new product acquisitions, and potential broader merger acquisitions within the industry sector. I think that opportunity of any sort of optimism that flows out off the back of next week's meeting, if we were to see the stock trade back up towards sort of 9.70, I'd take that as an opportunity to sell the covered calls and drive some added income. The stock's on a 6% dividend yield. It probably can trade back up to around $10, but over the next 6 months I don't see it doing too much more than that, so it's a case of selling those covered calls to complement the dividend income. Computershare, continue to like this name, another beneficiary of a lower Aussie dollar should that play out. At about 19-20 times earnings, a stock expensive, should deliver maybe 5 to 10% earnings growth going forward. Ideally, I'd like to pick this name up at a lower price point, but it's certainly on the radar at the moment. CSL, we continue to like this at about 22 times earnings. It's expensive, but 10% earnings growth, and the company's still buying back its shares. I don't see downside risk in the stock much below sort of $66. So it's a buy on the dip up at around 72. We're selling covered calls and taking profit up at that level. Fortescue, I'll just jump back to Fortescue, so you can see here the real impact of a pure iron ore play with the current sell-off, probably back down around 450. We'll keep an eye on Fortescue as we expect it to find support at or near that level. These property stocks, Goodman Group, compressing down a 4% dividend yield, roughly at 5% yield it was value. At 4% yield I don't see the market compressing it any further, even though Goodman Group's one of the faster growing property stocks, about 7% earnings growth, but it should run into resistance here at around $5. GPT, we're buyers of it on a sort of almost a 6% yield down here. We're now selling it as it compresses down to a sort of 5% yield, taking profit around 390. Happy to take another look at it back at around 350 should that play out over the months ahead. IPL reports their earnings results on Monday. I'd expect this to maybe surprise to the upside. We've got better DAP prices. The Maramba project is certainly contributing to the bottom line, and we haven't seen any sort of comments out of the company around outages or slow productivity out of the Maramba project. So I'd expect that to flow through to more optimistic outlook for IPL, and even the current result to be announced on Monday should be reasonably strong. I have the stock trading on about a 4% dividend yield and about 13 times earnings, so from a valuation standpoint relative to the rest of the market, IPL looks okay. Lendlease, a little bit expensive up here, now down at 3% dividend yield, trading about 14 times earnings. Keep in mind they didn't deliver much in the way of earnings growth in the recent result. Over the next 12 months, the market's looking for around 5% earnings growth, but the pipeline of business that Lendlease has coming through over the next 2 or 3 years should underpin earnings, so it's definitely a buy on the dip should the stock pull back. Macquarie, so their earnings results came out in the last week. We've seen a result of around 1.2, 1.3 billion. Keep in mind 300 million of that belong to Sydney Airports. So the company made the comment that they're likely to see the forward 12-month earnings similar to the past, which essentially means that the underlying business is going to have to grow at around 20% to replace that 300 million from the Sydney Airport sales. For my liking, that just starts to make the stock look a little expensive, given that it's already priced on the basis that the company's going to deliver that. So really, for the stock to perform beyond this price point, you need to form a view that it's going to grow 20% year on year over the next couple of years. And I just think it's starting to get a little bit risky up here. But certainly the macro outlook for equity markets, if they were to remain reasonably strong, which is our base case, I think sort of Macquarie is certainly a stock that we'd take a look at again if a sell-off occurred in the months ahead. NAB, happy to be a buyer of NAB on this sell-off. As with Westpac, they're probably really NAB, ANZ and Westpac at the moment. I think it makes sense to have exposure to them. That needs to be balanced with reasonably tight covered calls, as I do see sort of these stocks mainly moving sideways through to sort of that August-September period. Newcrest, I'll just jump back to that. So as I touched on the gold price at the beginning of the recording, we would need to see gold really trade back up to around $1,500 an ounce, and in that environment I think Newcrest can sort of recapture somewhere around $17, $18, but it'll be interesting to just see over the months ahead how that plays out. Origin, up at these levels it's looking a little expensive. We have been happy to buy the stock even on this recent sell-off, but we've been fairly aggressive. We're going out and selling the $16 covered calls. It's boosting that cash flow from sort of 4% dividend yield or 3.5% dividend yield up to around 10% dividend yield, and giving for some capital growth. But with the stock up here at 20 times earnings, the probability of it really sort of taking off in the months ahead I think is pretty limited. Certainly into the latter part of this year and mid next year, I'd expect to see Origin trading much higher, as I think the company can return back to delivering 10 to 15% earnings growth as the new production comes online. Oil Search, probably just skipping through till, so Rio we're not, so Stocklands pays its dividend at the end of June, roughly 12 cents. The underlying business is growing about 6%. This is a name, so Stockland and Transurban are probably the two of interest that paid dividends in the June period, and we've continued to be buyers of these names. In the case of Stocklands, we're selling the calls up at around 4 to 4.10, and I don't see the stock sort of trading too much above that again across the next sort of 3 to 6 months. Sonic Healthcare, we've been recent buyers of this. I think it's a reasonably defensive addition of portfolios at 18 times earnings and a 4% dividend yield. Going out selling the 1850 covered calls again pushes that cash flow up to around 10 to 12%, adds for some opportunity for capital growth. But I think portfolio allocations at the moment, we're very much centred around trying to have a defensive skew to portfolios to these names that will be a benefit of a lower Aussie dollar, have robust earnings, likely to deliver 5 to 10% earnings growth, not too affected by change in macro sentiment or outlook for equity markets. So Sonic sort of fits that bill, and owning at these levels, selling the covered call and collecting the dividend makes sense for us. Santos, we're recent buyers of this on the pullback here at around 1350. We've sold the 1450 covered calls. And I think that's a good return there again, combination. So if you actually factor in what we collected for those covered calls, we're effectively getting an exit price up here at around 1480, and I think that probably sits at resistance short term, a little bit like Origin in the latter part of this year or mid next year. I think we could see Santos trading higher. Transurban, so coming up to paying its dividend in June. We're buyers of it again here on this sell-off. I think the stock will trade back up to around 725 to 730, and I think that's probably where it caps the upside. At that level, it puts the stock on about a 4.25% dividend. I don't see it compressing any further below that. So any move back up to 725, we'll take that as an opportunity to sell the covered calls. Telstra here at the moment, so we've just recently sold the calls at around the 540 level into the end of the year, into December. They're a European style, so we'll collect the August dividend, and that adds to the cash flow there with Telstra. Underlying earnings growth probably somewhere around 3%. The stock trades 15.5 times earnings on a 5.5% dividend yield at present. Toll, starting to move back up towards our target. We own it at lower levels here at around 540. We want to look to sell the covered calls up at around 560 to 570. I don't see the earnings power of Toll really driving the stock too much higher than that. It's on 13 times earnings and a 5% dividend yield. The market's looking for about 5% earnings growth in the 12 months ahead out of Toll. Westpac's earnings result was very robust, $3.7 billion profit, dividend 90 cents. Maybe the market was a little bit disappointed that there wasn't an announcement of the special dividend, but the probability of that coming through in the next half is quite strong. So I think an opportunity to buy the stock on any weakness, whether it's today or over the next week in this current sort of profit-taking or selling phase that the market's going through at the moment, makes sense. To buy the stock down here, you're effectively picking up Woolworths, Westpac, on a 5.5% dividend yield, about 15 times earnings, which again makes the stock not good value, but I think from a defensive earnings perspective and the underlying growth in the loan book and the falling bad debts at around this sort of 34.50 level makes sense to buy it, collect the upcoming dividend and sell the covered calls over Westpac. WDC, so we've just seen them announce they've sweetened the deal with Westfield Retail. They've added or removed another $300 million of debt in the Westfield Retail Trust, so effectively providing slightly more value for the Westfield Retail Trust shareholders. Our strategy still remains that ultimately we want to be exiting WRT and staying focused on being owners of WDC. At these levels, the stock trades at about 16 times earnings on a 5% dividend yield, and I think it's a buy on any weakness right here at the moment. Wesfarmers, trading about 20 times earnings on a 4.5% dividend yield. Underlying business on a forward outlook should grow about 8%. I think the stock's reasonably expensive, but it does provide a defensive mix to portfolios, and owning the stock here, selling the covered calls, driving the cash flow from 4.5 up to 10 to 12% makes sense. I think this is one of those names that sort of fits that bill again, where we're looking for sort of defensive assets that provide some capital growth, but we're able to drive that 10 to 12% cash flow off the dividend and the call premium. Woolworths, we're looking, so happy to be a buyer again of Woolworths. If we were to get another sort of down day or two over the coming few trading days, somewhere back at around $35, we're happy to take another look at Woolworths. On a forward outlook, the company should grow earnings at about 5 to 6%, puts the stock at about 19 times current earnings and less than a 4% dividend yield. So I'd probably think, anything below 4% dividend yield's not sustainable for Woolworths. Probably at a 4.5% yield puts the stock at $35, and that's roughly where I see sort of fair value there for Woolworths. Woodside Petroleum, we started taking profit after owning it at lower levels. The stock on a forward outlook probably won't deliver too much in the way of earnings growth, but at about 14 times earnings and a 6% dividend yield, the stock's good value. So at the moment it's compressing back down to about 5.5% yield. I'd expect WPL, Woodside Petroleum, to trade back to around $40. And then finally back to Westfield Retail, as I discussed. All right, thank you for listening to today's recording, and if you'd like to know more about the Investor Signals Premium Account service, please contact me using the details on screen.